Hello everyone, my name is KMP Karunanayaka. I am from Holmes Institute, Melbourne. My student number is ENE3378. Under the corporate accounting, today I am going to do a presentation about accounting for income tax. My presentation aim is to develop a clear understanding on corporate accounting for income tax issues and also develop an understanding on different concepts used in uh, accounting for income tax, and then how these different concepts of accounting for income tax are used by companies in practical setting. For that I have used Telstra for many there are, because of many reasons. That's one of the reason is tender seta in uh, business field in Australia, and also nearly 50% uh, mobile connection market shares, and also they are the they are the first Australia's 5G network uh, introducer. So uh, as their last year financial performance, you can see around 28 billion total income. So let's move to the presentation. Concept of the accounting. Under the concepts of the accounting profit, when all the business costs are assumed up together and that was deducted from the total of the organization debit, we got the accounting profit. As you can see, Telstra's last year and in 2019 accounting profit. Taxable profit. Taxable profit is the proportion of profit where the owner may be a person or organization, that they are liable to pay tax. Temporary difference. Temporary difference is the difference between the assets or liabilities carrying amount that recorded in the financial statements and its tax base. As you can see here, temporary difference recognized in the different deferred tax expenses in and in 2019 of Telstra. Taxable temporary difference. The temporary difference that occurred in the taxable amounts in the determination of taxable profits or loss future time period, where the carrying amount of the assets or liabilities settled in the referred as the taxable temporary differences. For an example, Telstra recognized taxability for all taxable temporary differences except the deferred tax liability arise from the initial recognition of goodwill. Deductible temporary difference. The temporary difference which can be occurred in amounts that can be deductible in determination taxable profit or loss future in times period when assets or liability carrying amount is recorded or settled. For example, deferred tax assets are recognized in Telstra to the extent that it's probable that taxable profit will be available as against which the deductible temporary difference and the carrying towards unused tax losses and tax credits can be utilized. Deferred tax assets. Deferred tax assets comprised of amount of income taxable recoverable in the future aspects of deductible temporary differences carrying forward unused tax losses and carried forward of unused tax credits. Uh, as you can see in the chart, deferred tax assets of the Telstra. Recognition criteria of deferred tax assets and deferred tax liabilities. There are many recognition criteria as you can see for deferred tax assets and also for deferred tax liabilities. Telstra's tax expense. The income tax calculated is the way difference from what is expressed in the annual report of Telstra according to the paper published by one of the university, this difference emerged because of any these reasons, including mandatory timing differences, voluntary timing differences, tax temporary reverse, non-deductible expenses like this, profit before income tax expenses and income tax expenses, Telstar's tax expenses and accounting income. The income tax calculator is the way different from what is expressed in the annual report of Telstar. In the balance sheet of Telstar, we can identify deferred tax assets or liabilities. For example, investments, capital tax losses, provision, properties, plant, equipments, those are in their balance sheet. Telstar current assets or income tax payable. No current assets is mentioned in the annual report 2019 of Telstar. In the same statement, they have elaborated that they have offset deferred tax assets and deferred tax liabilities in the financial statement, so they were related to income tax levies. Income tax payable. Once the income tax is calculated based on the standard account rules, it gives the income tax expenses owed by the company. Income tax payable is the actual amount of income tax paid as per the tax code. For example, this is the Telstar's income tax expenses and income tax paid year ending 2018 and 19. Income tax expenses and income tax payable. The differences arise in when income tax expenses reconciliate for the income tax paid as per the requirements of the voluntary tax transparency code. Concepts of temporary differences and permanent differences. Temporary differences are differences between accounting profit and taxable income that will reverse with the time and settling. It was interesting to see how the recorded income tax expenses from deferred tax expenses payable paid reasons behind the calculation were interesting. It is surprising to see the temporary expenses tax differences and how they will be recorded in the tax return with recording in the financial statement until they are settled. This activity was quite impressive, so it guided me through the depth of tax details published in the annual reports, and it gives a wide understanding about how they differ and why they are in the way they are represented. In the conclusion, in the Telstar annual report, the income tax expenses is recorded based on the Telstar accounting profit, adjusted for the differences in the accounting as well as tax treatments. Thank you.